Hello and welcome. Today we'll be talking with Timo Nicholaou, President of Consolidated Financial Management and Tax Services, about taxation and how it affects the elderly. Welcome, Timo.
Thank you.
So, what are some of the major issues that the elderly are facing today?
Well, one of the most predominant criteria that's been happening out there that they're facing is the loss of their real estate homestead tax credit. In order to get this credit, the property must be located in Michigan that you live in. You must be a resident for the past 6 months. And it includes if you rent a mobile home lot or if you rent a home or apartment. It does not include vacation homes or rental properties or investment properties that you may have. What it boils down to is the state mandated that if your income from all sources are over $50,000, or if your taxable value of your property is in excess of $135, that this eliminates the credit. What this caused was a lot of elderly that would get this credit to not get it. Because let's say, for instance, an elderly person that makes less than $50,000. Their home could possibly be worth more than $135 as a taxable value. And with that said, that ends up to be a $1,200 credit that they're not getting. That's a significant amount of money for someone on a fixed income.
Now, there are also many elderly people that are also disabled. How are they affected? Is it in a different way, or?
Yes, Kayla, it's a very good question. It is. In many instances, the elderly don't realize that they're entitled to this. Because they may be doing their own tax return or doing it incorrectly, they don't realize that they're entitled to some more credits. For instance, if they are 65 or older and they're disabled. In many instances, there's a type of way you do the tax return, and many people do what is termed the 1040 easy form. If you do this tax preparation in that manner, where someone, maybe a friend has done their taxes or a family member, and they're just trying to make it on the easy form, it does now allow them to get that credit. Credit could be a significant amount of money.
And speaking of income, aren't the elderly at a certain age, I think it's 70, required to take out money from their IRA?
Yes, that's correct, Kayla. At the age of 70 and a half, you have to start taking money out of a retirement account. And it's an area that's being heavily scrutinized by the IRS at this time. And the reason is, if you look at it for the past 30, 40 years that IRAs or 401ks have been in existence, there's a pile of money that's been accumulating. That's where most people's wealth are. And they're used to be in their house. We know it's not there anymore, or that's a lot less, but in their retirement accounts. So what happens when someone turns 70 and a half, they're required to take money out. It's called an RMD, Required Minimum Distribution. At the age of 70 and a half, the year that they turn 70 and a half, the following year, they have to take a disbursement of the account. There's a predetermined mathematical formula according to their age and longevity of life, actuarial tables. A lot of times the investment firm where their money's at tells them the amount that they have to take out. But the idea is that they have to take that money out. It's kind of a way that the government gets paid back. They're paying back the piper. You know, they put the money in and they didn't pay tax on it. Now it's time to pay tax. The year that they turn 70 and a half, as I mentioned, the following year they have to take that distribution out. But they got to be careful, because the year that they take it out then, they have to take it out for that year. So when they begin this process, the first year they probably have to take 2 distributions. No, it seems a little technical, but those that are doing it understand it. Those that are 69, turning 70, it's something that they're going to have to really talk to their financial advisor or tax preparer. Because one of the toughest things is, as I said, the IRS is scrutinizing this now because there's such a vast amount of money out there that's going to need P-tax, and that's what the government needs, is that money back. And the penalties are very harsh. Let's use an example that someone was required to take $5,000 out of their account, and they didn't do it. Excuse me. The penalty is 50% of that amount. So they'd be penalized $2,500 if they didn't take it out. So it is a pretty drastic penalty if they don't do this correctly. And as I mentioned, they should seek, when they're 69, 68, to start planning on what has to happen.
You mentioned these disbursements had to be taken out by the following year, correct?
Yes, yes.
Is there a deadline this has to be accomplished by?
It's a very good question, Kayla, and I know I didn't cover that. If they turn 70 and a half, the following year they have to take that disbursement. That disbursement has to be done by April 1st of that following year. It's very important that it's by April 1st because that disbursement constitutes the previous year. And then as I mentioned, also that sounded maybe a little more technical, they are responsible for that particular year now to be done by December 31st of that year. So in essence, there's two disbursements in that year that have to be done.
So hasn't there been recent legislation affecting taxing pensions and retirement plans by the state?
Yes, that's another, pardon the expression, doozy that the elderly are facing. And what it is in the past, these were not taxed. And as you can see what our state has gone through, not to get political in any manner, things are tough out there. And with a new governor, there's new things mandated. And one of them was to start withholding on the elderly's pensions. And what this causes is them not getting enough money and cash flow throughout the year. And this tax on this amount ends up to be 4.35% of that amount. Now, people born before 1946 are not affected in any manner by this. Those born after 1946 see what's called a phase-in approach of how this happens depending on their income levels. But there is withholding that has to happen on these now. A lot of elderly seem to be frightened by it. Not all of them are affected by it. So again, they should talk to their tax planner or financial advisor to make sure they are withholding appropriately, because not that there's any significant penalties, but they don't want to maybe owe a lot at the end of the year.
What are some major points that you'd like our viewers to take away from this segment?
Really, the two major things are for them to be cognizant of the property tax, the homestead property tax credit either being phased out or not eligible for it, in addition to the taxation on their pensions. This can mean a few $1,000s to the elderly, as I mentioned earlier. A few $1,000s on someone on a very fixed income is a significant amount of money. The other thing would be is, in many instances they feel it's very costly to go to professionals, and it's really not compared to what they could be missing. A couple $1,000s on a refund is a significant amount of money that, as I mentioned, we've seen people come in that pencil in their return or in ink and cross out, because we'll examine previous years, and a professional will examine previous years. And it's not uncommon for them to have done this for a handful of years and be entitled to money. So it's really important for them to have their other previous years reviewed by someone.
Well, I think that's all we have time for today. Thank you so much, Timo, for talking with us.
Thank you for the opportunity. It's been a pleasure.
Timo Nicholaou is president of Consolidated Financial Management and Tax Service. He has been in business for 30 years, operating his practice in downtown Rochester. He is currently in the process of making his home in Lake Orion and will be opening a tax practice in downtown Lake Orion at 214 South Broadway this January 2014. For more tax tips, you can contact Consolidated Financial Management and Tax Services at 248-650-6900.